Money is the lifeblood of all of our established institutions, and thus society itself. Understanding this institution of monetary policy is critical to understanding the way our lives are controlled. Economics is viewed with confusion. Endless streams of financial jargon coupled with intimidating mathematics quickly deters people from attempts at understanding it. The fact is, the complexity of the financial system is a mask designed to conceal one of the most socially paralyzing structures humanity has ever endured. The Central Bank of the United States, the Federal Reserve, produced a document entitled Modern Money Mechanics. This publication detailed the institutionalized practice of money creation as utilized by the Federal Reserve and the global commercial banks it supports. The document states the purpose of this booklet is to describe the basic process of money creation in a fractional reserve banking fiat money system. This fractional reserve process through banking terminology. The United States government needs some money, so it calls up the Federal Reserve and requests a $10 billion. The Fed says, "Sure, we'll buy $10 billion in government bonds from you," so the government takes some paper, paints some official-looking designs on them, and calls them Treasury bonds. Then it puts a value on these bonds to the sum of $10 billion and sends them over to the Fed. The Fed draws up a bunch of impressive pieces of paper themselves, only this time calling them Federal Reserve notes, also designating a value of $10 billion to the set. These are the bills you carry in your wallet and spend when you buy something. The Fed then takes these notes and trades them for the bonds. When this exchange is complete, the government then takes the $10 billion in Federal Reserve notes and deposits them into a bank account, and the paper notes officially become legal tender money, adding $10 billion to the U.S. money supply. And $10 billion in new money has been created. In reality, this transaction would occur electronically with no paper used at all. In fact, only 3% of the U.S. money supply exists in physical currency. The other 97% exists in computers as digital currency. Government bonds are instruments of debt, and when the Fed purchases these bonds with money it essentially created out of thin air, the government is actually promising to pay back that money to the Fed. In other words, the money was created out of debt. This mind-numbing paradox of how money with value can be created out of a debt liability will become more clear as we continue. The exchange has been made, and now $10 billion sits in a commercial bank account. Here is where it gets really fascinating, because based on the fractional reserve requirements of the Fed, that $10 billion deposit actually becomes part of the bank's required reserves. Just as all deposits do, reserve requirements, as stated in Modern Money Mechanics, a bank must legally maintain required reserves equal to a prescribed percentage of its deposits. Under current regulations, the reserve requirement against most transaction accounts is just 10%. This means that with the $10 billion deposit, $1 billion is held as the required reserve. The other $9 billion of the reserve can be used as a base to make new loans. Now, you would think that this $9 billion is coming out of the existing $10 billion reserve deposit. You would be wrong. This is not the case. What really happens is that the $9 billion is simply created out of thin air on top of the existing $10 billion deposit. This is how the money supply is expanded, as stated in Modern Money Mechanics. The banks do not make loans from the money they receive as deposits from their customers' saving accounts. If they did this, no additional money would ever be created. What they do is, when they make loans, is to accept promissory notes, loan contracts, then exchange these contracts for dollar-denominated credits that are credited to the borrower's checking account. In other words, the $9 billion can be created out of nothing simply because there is a demand for such a loan and that there is a $10 billion deposit to satisfy the reserve requirements. Now, let's assume that a customer of this bank borrows the newly available $9 billion. They will then take that money and deposit it into their own bank account. The process then repeats as that deposit now becomes part of the bank's reserves. Just as all deposits do, and regarding reserve requirements, as stated in Modern Money Mechanics, a bank must maintain legally required reserves equal to a prescribed percentage of its deposits. 10% is isolated for required reserves, and 90% of the $9 billion or $8.1 billion is now available as newly created money for more loans, and, of course, that 8.1 billion can be loaned out and redeposited, creating an additional 7.2 billion to 6.5 billion to 5.9 billion, etc. This deposit money creation loan cycle can technically go on to infinity. We will stop at 9 cycles. The result is that about $90 billion can be created on top of the original 10 billion. In other words, for every deposit that ever occurs in the banking system, about 9 times that amount can be created out of thin air. So now that we understand how money is created by this fractional reserve banking system, a logical yet elusive question might come to mind: what is actually giving this newly created money value? The answer is the money that already exists. The new money essentially steals value from the existing money supply, for the total pool of money is being increased without demand for goods and services, or an increase of goods and services. And as supply and demand finds equilibrium, prices rise, diminishing the purchasing power of each individual dollar. This is referred to as inflation, and inflation is essentially a hidden tax on the public. How in the world can we expect to solve the problems of inflation? That is, the increase in the supply of money with more inflation. Of course it can't. The fractional reserve system of monetary expansion is inherently inflationary. For the act of expanding the money supply without there being a proportional expansion of goods and services in the economy will always debase a currency. It gets even worse. Absurdity is an understatement in regard to how our financial system really operates, for in our financial system, money is debt and debt is money. Here is a chart of the U.S. money supply from 1950 to 2006 with a chart of the U.S. national debt for the same period. How interesting it is that the trends are virtually the same. For the more money there is, the more debt there is. The more debt there is, the more money there is. To put it a different way, every single dollar in your wallet has been borrowed many times and is owed to many people at the same time. Remember, the only way the money can come into existence is from loans. Therefore, if everyone in the country were able to pay off all debts, including the government, there would not be one single dollar in existence. This is why zombie debt is so valuable in our monetary system. Because 95% of zombie debt will never be paid off. So our money system is safe from collapsing to zero. The international bankers installed the central bank in 1913, the Federal Reserve, and as long as this institution exists, perpetual debt is guaranteed. Now, so far we have discussed the reality that money is created out of debt through loans. These loans are based on a bank's reserves, and reserves are derived from deposits, and through this fractional reserve system any deposit can create 9 times its original value. In turn debasing the existing money supply, raising prices in society, and since all this money is created out of debt, and circulated randomly through commerce, people become detached from their original debt, and a situation exists where people are forced to compete for labor in order to pull enough money out of the money supply to cover their costs of living. As dysfunctional and backwards as all of this might seem, there is still one more thing we have omitted from this equation, and it is this element of the structure which reveals the truly fraudulent nature of the system itself. And that is interest. When the government borrows money from the Fed, or when a person borrows money from a bank, it always has to be paid back with accrued interest. In other words, every single dollar that exists must be eventually returned to a bank with interest paid. But, if all money is borrowed from the central bank and is expanded by commercial banks through loans, only what would be referred to as the principal is being created in the money supply. So then where is the money to cover all the interest that is charged? Nowhere. It doesn't exist. The ramifications of this are staggering. For the amount of money owed back to the banks will always exceed the amount of money that is available, created, and ever in circulation. This is why inflation is a constant in the economy, for new money must always be created to pay the perpetual deficit built into the system, caused by the need to pay the interest. What this also means is that mathematically, defaults and bankruptcy are literally built into the system. And there will always be poor pockets of society that get the short end of the stick. And that's the point, it invariably transfers true wealth from the individual to the banks. If you are unable to pay for your mortgage, they will take your property, or your car, or your credit score. This is particularly enraging when you realize that not only is such a default inevitable, due to the fractional reserve practice, but also because of the fact that the money that the bank loaned to you didn't even really exist in the first place. Remember what modern money mechanics stated about loans: what they do when they make loans is to accept promissory notes in exchange for credits. Reserves are unchanged by the loan transactions, but deposit credits constitute new additions to the total deposits of the banking system. In other words, the money doesn't come out of their existing assets, the bank is simply inventing it, putting up nothing of its own except for a theoretical liability on paper. Now you understand, zombie debt still exists in the system, thus the money associated with it still exists. When a loan is paid off, the money ceases to exist, it disappears from the money system. This is why zombie debt is so important, it's basically the only debt that will exist forever, thus keeping inflation high. If all zombie debts were to be paid off or forgiven, inflation would not exist. It would actually go down. No bank or government wants this, because inflation makes government debt interest-free. If you would like to find out how to make money with zombie debt, contact info is in the description.